So let us go for different classification of the special closed funds. Already have explained you about classification in previous classes and investment objective strategies based on the investment objective, what kind of a classification, how it is considered, and we can see here special consideration for closed-ended funds. Already it has been explained to you about how this is totally different from traditional fund, and I have said closed-end funds have a unique character which is required special consideration, and some of the key consideration based on the different factors, and this is classified based on the different objectives. Now closed-end funds has a two types of objectives and strategy. One is about investment objective. Understand the fund investment objective such as the income generation or the capital appreciation, and it is classified investment strategy to recognize the fund based on the investment strategy including different types of securities. So there are multiple choices, multiple options, and how the fund can be enabled to classify closed-end funds, making differentiate between traditional mutual fund and or closed-end funds. Now you can see the slide where it has been explained that they share the trade, especially the company trade exchange, and trade is exchanged between the stock exchange at different prices by supply and demand. It is determined with that supply and demand. Then you have a prices may trade based on the premium or discount. Premium is an always added price, and the discount is always with the uh, one step down where you can giving for less price compared to the market value. So prices may trade within the premium, prices may be traded between the discount. It depends with the sentiments in the market. So price may be differentiated from one trade to another trade. So closed-end funds have a different calculation, but when we go for the closed-end funds, you have a different structures like closed-end structure, leverage, distribution policy. So one of the structural character of a closed-end funds, like I said about CEF, have a fixed number of shares which can lead to discount or premium to a net asset value. And leverage talks about use of leverage which can amplify the return. So leverage, you know that debt and a company which have a debt and equity, the combination of debt and which is enabling you to you pay dividend, you pay interest, what return is expected, and how this will increase the risk. So here the closed-ended funds are traded in the stock exchange based on the leverage, and distribution policy, understand the fund distribution policy, frequency and the amount of distribution. And coming to the valuation and the pricing of closed-end funds, like they are priced and valued based on the discounts and the premium. And discount premium, already I said, discount or premium to their NAV value, which have impact on the investment return. Then you have a market price volatility, and here you can see that demand and supply depending on the market sentiment. And the market price volatility talks about market sentiment and fund specific event or interest rate. Whenever change in the rate of interest, it has a huge impact on stocks. So it classify might be increase or decrease in the value in the stock exchange, automatically increase price based on which price, decrease price based on what impact. Then you have a regular consideration under closed-end funds, like registration, the compliance, register with the Security Exchange Commission, they comply with the relevant regulations. Then they go for disclosure of requirements, must have a disclosure with the certain information. Then this disclosure requirement is classified further with the investment objective or strategy risk. So there is a certain tax implication. So tax or taxation of distribution, understand how closed-ended funds distributions are taxed, including the potential of ordinary income, capital gain, or return on capital or return of capital. So how it is taxed, and taxation of sales, like recognize the tax implication of selling CF, especially you have a closed-end funds, how the tax on sales based on the shares, including the potential capital gain or losses. So other consideration like liquidity and fees or expenses. So in CF closed-ended funds, you have a liquidity aspect, where one of the consideration talks about CF can also be less liquid than other investment options. Why? Because their potential making it more difficult to sell shares quickly. So that one of the reason. And there is a certain fees attached expenses, including like administrative cost or management fees or any other expense. So it is considered very systematic and clearly. Now coming to the eighth point, that is the NAV for different types of mutual fund. So when we talks about different types of mutual fund, you have a growth mutual fund, income mutual fund, balance mutual fund, and you have a tax saving mutual fund, equity funds, debt funds, or hybrid mutual funds, sectoral funds, index funds, money market fund. This all have been explained before. So net asset value for different types of mutual fund. One is equity based stock, which has been the company making deal with the stocks, buying and selling in form of shares, buying in form of stocks. So NAV fluctuate with the stock market performance. So 100% net asset value, asset minus liability, it has a huge impact on the fluctuation with the stock market performance. And you have bond funds, which ultimately you need to return based on the certain interest. Your market is high, your market is low. So NAV changes based on the interest rates and the bond price movements. So there is a money market funds like NAV generally stable. Example is given out from fixed $1 per share in the US, as these funds invest in the low risk short term instruments. So money market funds. So money market funds already have been explained to you, where money market funds invest in the short term debt security, providing low risk return and liquidity. They will deal with the investor seeking the park surplus funds on the short duration. So if you have a surplus fund where you can make a short-term investment and short-term through instrument, you get a low risk and return on the investment can be expected somehow. So this is how explained under NAV under different types of mutual fund. Then next concept is all about the understanding mutual fund expenses and fees is crucial for evaluation the cost of investing, its impact on the return, and the breakdown of types of expenses, fees associated with the mutual fund. So the next concept in your syllabus, it is explained about how to understand the mutual fund expenses and the fees, and how crucial for evaluating the cost of investing and its impact on return. Then how this is breakdown types of expenses, fees associated with the mutual fund. This is how it has been explained. So you should know that there are various expenses ratios, various administration fees, various management expenses. Now how to break down all this type of expense and fees associated with the mutual fund. Now first type of expense ratio, first type is an expense ratio. Now everyone should know that expense ratio is a crucial factor to consider when understanding mutual funds. Like expense ratio represent the percentage of mutual fund assets that are deducted annually to cover operational expenses, then management fees and other costs. So you can see the definition here, the annual percentage of mutual fund asset used to cover operating expenses, express percentage of find average assets under management. So what we call asset management. So assets under management, AMU. Now some of the component of expense ratios, you can see here, like management fees, compensation for fund manager or investment team, administrative costs, cost for accounting, legal, record keeping services, then marketing and distribution fees, where you have a fees for advertising, sales and investor services. So there are multiple fee structure. You might be, other than this, you have a audit fees or the legal fees, where audit fees, the legal fees cover the cost of auditing legal services. Or if I talk about distribution and service fees, where paid to the distributor or the broker or any other intermediary. Then if I go for other expenses, I can explain about miscellaneous costs like travel, training, technology. See, the component of expense ratio in the mutual fund are many, but it has focused on the main important five factor. One I can tell you, one is about the management fees paid to the fund manager to investment decision and portfolio management. So manager is going to look into the portfolio management, so he has been paid additional management fees to be paid fund manager for investment decision and portfolio managing and administrative costs. I said like office rent, salary, marketing, all this comes under administrative costs, and these are the extra additional expenses under expense ratio. Then audit fees I said, distribution fees I said, service fees I said, other expenses I said, all these are covered under expense ratio. There is some of the impact of expense ratio too, like reduces return. Higher expense ratio can eat into your investment returns. See, that's what I said. More and more expenses will increase your cost, which will eat your return on your investment. Then it affects the net asset value, like expense ratio is deducted from funds of NAV, reducing the value of your investments. This is how it goes, and this is how it is invested, and it is very clear how systematically it is invested and how it is classified. Then there are different types of expense ratio too. So you have a gross expenses or your net expenses. Like when we talk about gross expenses, total expense ratio before any waive or reimbursement, that become a gross before deducting any of the expenses. Then net expenses ratio talks about ratio expenses waive and with the reimbursement after expenses after waiving or the reimbursement, that become net after minus. And normally you know that when you pay the gross salary after deducting all expenses, you get a net income. So this is how it's calculated. So how to choose the mutual fund under lower expenses? So you need to compare with the expense ratio, check the fund investment objective, evaluate the performance. This is how it is classified, and you have a regulatory limits on expense ratio too. So SEBI regulation, if you see, the Security Exchange Board of India regulate expense ratio for mutual funds in India. There is upper limit, like SEBI set up the upper limit for expense ratio, which vary depending on the mutual fund type, the size of mutual fund type. So this is how it is classified under expense ratio. And next you have a types of mutual fund fees for management fees. First I said you had a first fees as an expense ratio. Second one is in management fees. So management fees, it is the purpose of pay fund manager for selecting managing fund investment. Range become typically 0.5% to 1% fund assets annually for actively managed funds, lower for index funds, right? And you have administrative costs like management fees. I said administrative costs purpose cover day-to-day operational expenses including custodial service. Custodian will become a person who hold and safeguard the security in form of investments. Then you take as a legal accounting services, it comes under administrative costs, and they might be paying rent or office salary. All this comes under administrative expenses. So shareholder communication reporting, you just go for notification, you just go for advertisement, you just go for giving brokerage. All these are part of the purpose of day-to-day coverage operational expenses, and this is the example shown to you. Then you have a fees like marketing and distribution. One of the fees will be marketing and distribution about your fund, uh, to know about what type of fund, exactly what is the valuation of this fund, the purpose of it is 12B1 fees. It is considered here with form of use for marketing, advertising, compensating broker or financial advisor, capped at 1% annually. Then in case of often lower cases 0.25% to 0.75%. Then sales load, like purpose will be commission paid to broker, financial advisor for selling the mutual fund. There are types of sales load. In case of front end load, like deduct when shares are purchased 3 to 5% of the investment. Back end load, like deferred sale, which will carry charge where shares are redeemed, often decreasing over time. Like redemption, there is a specific redemption date or redemption period, how long, like 1 month, 2 year, or 5 year, it goes like that. So calculation of back end load. Then low load funds, there are no other expenses in the sales fund without any sales load, but may still charge other fees. So this is how it is calculated. Then you have a transaction cost. Like purpose will be cost associated with the buying and selling of security within the fund portfolio. It has an impact on how funds may incur higher transaction costs, reducing return. That is the impact. Then redemption fees, like discourage frequent trading by charging fees when investors sell shares shortly after purchasing them. Then it has a range of 1 to 2% of redemption amount. Then there is an account maintenance fees, where the purpose will be charged for managing small account, certain account services. There is a certain flat fees as a range fixed. Then third one, when we talks about expenses ratio, then management fees, impact of fees on returns. 100%, when your fees increases, expense ratio increases, automatically the fund calculation value also will go high. So buyer need to buy for higher prices. So mutual fund fees reduce the overall return on investor earnings. That's what I said. When expenses increase, the earning will come down. So net return is equal to gross return minus expenses. So that expenses part is a part of expenses where your further income has cut down. When your expenses increases, overall return on investment will reduces. So lower expense ratio are especially crucial for long-term investor. Even small difference can significantly impact on compounding the return. So you low expenses, automatically it has an impact on the lowering down of your prices of your stocks based on this certain calculation, how it is connected based on the impact on the returns. So normally when we call ROI, I can give you an example here: debt and equity. You invest in the equity in form of dividend paying, which is a form of market fluctuation. When it's come for debt, you pay debt based on the fixed rate of interest, and this interest, which is fixed, they might be fixed interest, but they are the lower expense than the equity. So how this is classified, that's why sometimes the debt has a more market value than the equity. Why? Because the expenses, part of expenses, you need to get like equity have huge expense to bear, including market fees, advertisement, sales, promotion, and many other. But when it's come for expenses in form of debt, it has just kind of a brokerage. If it is required, then only, otherwise no brokerage service has to be paid when it's come for debt option. And fourth one, you have a actively managed versus passively managed funds. Now let us see the active managed funds, like tend to have a higher fees due to research management costs. Expense ratio typically 0.5%, 2%. Then passively managed funds, index funds, lower fees since they track index without active management. So expense ratio typically 0.5% and 0.25%. So this is what we are seeing. There are huge impact on the fee structure. When we go into fee structure, you should see what exactly actively managed fees and passively managed fees, and how these funds are really required when it's come for investment. So there are further classification: investment made in form of what. We are seeing starting from the expense ratio. I have said about expense ratio from the beginning. um, Based on the classification of the ratio, the ratio will be management fees, the administrative cost, distribution, audit, and any other expenses. And it has said it has an impact on the return. It might be fees on return, impact on the fees on return. Then I said actively managed, passively managed. I said about the gross expenses ratio, net expense ratio, comparing with the expense ratio, check the fund investment objectives. And I said about how to evaluate the fund performance, like whether they are the high risk profile, the low risk profile, whether they have a historical performance. Based on that, expenses you're going to incur. All these are further classified. Then I said about the regulatory limits of expenses ratio, SEBI regulation, upper limit. Then understanding this expense ratio are very crucial, and this become important component where you can be informed to make a good decision. So normally people just go for looking into different types of mutual fund, but they never go through for what is the hidden expenses in this mutual fund. So every investor need to know about what are the charges charged on the buying of mutual fund, what are the further expenses has to be incurred after buying of mutual funds. So there are multiple options. So I'll stop here. Remaining we'll see in next class, and we continue the same portion of the character and expenses in the next class. Thank you all.